Heard the saying, don't put all your eggs in one basket? That's basically the core idea of diversification in investing. If you trip and drop that one basket, all your eggs are gone. But if you spread them across a few baskets, you might only lose one or two. So, what does this mean for your money? Diversification is about spreading your investments across various assets so that your entire portfolio doesn't depend on the success of just one. Imagine you only invested in a single tech company. If that company's stock plummets, your investment value takes a huge hit. But if you also owned shares in a healthcare company, a consumer goods company, and maybe some real estate, the poor performance of that one tech stock wouldn't sink your whole ship. This strategy helps to smooth out the inevitable ups and downs of the market. When one part of your portfolio is down, another part might be up, balancing things out. Think of it like a seesaw. This reduces your overall risk and can lead to more consistent returns over the long term. You can diversify in a few key ways. One is by investing across different sectors, like technology, finance, energy, and healthcare. When tech is in a slump, maybe energy is booming. Another way is to diversify across different asset classes. This means mixing stocks, which are higher risk, but have higher potential returns, with safer assets like bonds or even real estate. Now, this might sound complicated, but it doesn't have to be. Exchange-traded funds, or ETFs, make diversification super easy. An ETF is like a basket that already holds hundreds, or even thousands, of different stocks or bonds. By buying a single share of an S&P 500 ETF, for example, you're instantly invested in the 500 largest companies in the US. It's diversification in one click. Let's look at a simple example. Say you have $1,000. Instead of putting it all into company A, you could put 200 into company A, 200 into company B, from a different industry, 200 into an international stock fund, 200 into a bond fund, and the last 200 into a real estate fund. Now your investment isn't riding on the fate of a single company. It's important to know what diversification is not. It's not about picking a bunch of stocks in the same industry. Owning 10 different tech stocks isn't true diversification. It also doesn't guarantee you won't lose money, but it does significantly lower your risk of a catastrophic loss. So to recap, diversification means spreading your investments to reduce risk. It smooths out your returns by ensuring your portfolio isn't reliant on a single asset or sector. And with tools like ETFs, it's more accessible than ever. It's one of the smartest moves you can make for your long-term financial health. Thanks for watching. If you found this helpful, give us a like and subscribe for more simple finance tips.